Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Okay, so the financial ground beneath us feels like it's experiencing a pretty seismic shift right now. I mean, this isn't just the usual ups and downs.
No, not at all.
We've seen some major warnings from, financial heavyweights, these massive policy changes in Asia that are fundamentally reshaping whole sectors and just whiplash in the bond market. All of this crammed into the last week or so. This deep dive feels really crucial because the whole investing landscape seems to be pivoting.
That pivot really is the common thread, isn't it? Looking at recent analysis, the market is aggressively moving away from chasing that pure, maybe speculative growth.
Oh, yeah.
And it's now demanding profitability, real financial quality, and genuine policy-backed value. So we're going to unpack four major forces defining this transition for you. First, that sudden surge in concern about AI profitability risk. Second, the big policy shifts driving Asian markets. Third, what that means for strategy, this two-track investing idea. And finally, the extreme volatility we're seeing in fixed income.
Got it. Okay, let's unpack that first point, the shift in risk appetite. What really jumps out is, it feels a bit like 2008 again, doesn't it? We're seeing some key players from the Big Short popping up again.
Yeah, the names are familiar.
Suggesting they see a bubble, but this time it seems centered on, AI infrastructure.
The data definitely supports that sense of alarm.
Yeah.
I mean, if you look at the latest regulatory filings, the 13Fs from around November 6th, Michael Burry's firm significantly increased its bearish bets.
How significantly?
Well, specifically, they boosted their put options, which are basically, big insurance bets against stocks going up against key AI names like NVIDIA and Palantir. We're talking over 30% higher than the previous quarter.
Wow. Okay, that's a pretty strong signal of skepticism about current AI valuations, right?
It really is.
But the concern seems to go deeper than just the stock prices. When you look at the sort of financial plumbing, there's some real anxiety brewing. Deutsche Bank, for instance.
Right. A name also familiar from '08.
Exactly. And now they're apparently considering selling something called synthetic risk transfers, SRTs, to hedge the risk on loans they've made for AI data centers. If banks are trying to offload this risk, what exactly are they worried about?
They're worried about what we're calling the profitability dilemma. Look, AI revenue growth looks fantastic, no question.
Right, the top line is great.
But the CapEx, the capital expenditure needed to actually build those data centers, it's astronomical. You're buying millions in super expensive chips, massive power infrastructure. It all adds up.
Okay.
And recent earnings calls from the giants, think Oracle, Amazon's AWS, Microsoft's Azure, they show this massive investment is really eating into profit margins. Oracle, for example, reported a pretty startling 16% margin shock tied to its AI cloud services.
So let me get this straight. It's like, okay, imagine someone takes out a huge loan to build the fanciest, most high-tech food truck ever. Amazing truck.
Right.
But then the cost of the fancy ingredients in running the truck is so high, they have to sell their gourmet tacos for almost no profit just to get customers in the door.
That's a great analogy.
Eventually, the bank that lent them the money for the truck starts thinking, hold on, can they actually afford the loan payments if they're not making any money on the tacos?
Precisely. And that's where these SRTs come in. They're
That's
essentially like insurance policies the bank buys. They transfer the risk of those data center loans defaulting onto third-party investors.
Okay, transferring risk.
But what's fascinating and maybe a bit concerning here is the mechanism of the SRT itself. It lets the bank manage its regulatory capital ratios, how much safety cushion they need to hold by packaging up the credit risk of those loans and selling it off in tranches, like slices of risk. Which, as you hinted, sounds quite similar to how CDOs, those collateralized debt obligations, were structured back before 2008.
Wait, so if they're just slicing up the risk and moving it around,
Yeah.
doesn't that sound really complex and potentially, hidden? Is that why people are drawing parallels to the systemic risk we saw in the last financial crisis?
It is warranted because the complexity itself is the risk. When you slice and dice and distribute credit risk through these really complicated financial products, well, if the underlying loans start to go bad, in this case, maybe the AI data center loans,
Right.
then the defaults can ripple through the whole financial system via these complex, often opaque contracts. It raises that specter of a systemic domino effect.
Okay.
That's why you see someone like Burry betting against the stocks and a bank like Deutsche looking to hedge the actual loans. The market's message is becoming clear. The AI growth party, It now has to prove it can actually turn a profit.
Okay, so if that speculative AI growth story is suddenly facing demands for like actual financial quality, where is the serious stability-focused money heading? The analysis seems to show a big pivot towards Asia, specifically policy-backed value stocks.
Yeah, this is a really powerful policy-driven shift happening simultaneously in two huge markets. First, in China, following what they call the fourth plenum, that's where the government sets its big multi-year strategic economic goals, the official focus has shifted.
Shifted how?
Towards qualitative growth.
Yeah.
And the key mandate coming down is forcing state-owned enterprises, the SOEs, which historically haven't always been the best performers.
Right. Often criticized.
To really prioritize profitability and increase shareholder returns. Think dividends, mainly. This is a fundamental top-down push for revaluation.
And South Korea is basically running the same play.
That's exactly right. Just around November 5th, the Korean government announced its Value Up Program 2.0. And this isn't just, a friendly suggestion.
No.
It comes with real teeth. Powerful financial incentives like corporate tax cuts and separate, potentially lower taxation for dividend income if companies significantly improve shareholder returns.
So direct rewards.
Exactly. And this move immediately puts the spotlight on sectors that have historically been criticized for low PBRs, price-to-book ratios, often because of, poor capital management or hoarding cash instead of returning it to shareholders.
That feels like the crucial insight here for you, the listener. Market leadership seems to be moving pretty dramatically away from just chasing the next big technology innovation and more towards betting on government intention. It sounds like investors now really need to follow the money trail being laid out by policymakers who are actively rewarding financial quality and shareholder returns.
And we can actually use the Korean market, which tends to be quite volatile and sensitive to global shifts.
A good leading indicator.
Yeah, often a good bellwether, you could say. We can
Right.
use it to see how the structural shift is playing out. What we're seeing there is the market splitting into two sort of viable investment engines. We're calling it the two-track portfolio.
Okay, two-track. So this isn't about choosing either AI or value, but more about balancing them somehow.
Precisely. You need that balance, right?
Right.
To manage the inherent volatility of the tech cycle while still participating in this structural, policy-driven revaluation.
Makes sense.
So track A would be the AI growth axis. It's more volatile, higher risk, potentially higher reward, focused on the leading edge of tech semiconductors, maybe companies like Samsung Electronics or SK Hynix.
Okay, the growth engine.
Right. And then track B is the value up axis. This is more stable, it's policy-backed, and it's focused on that structural revaluation potential in sectors like finance, banking, maybe shipbuilding, or automobiles, the ones directly benefiting from the value up program incentives.
And the key difference now for this value up track, it's not just hoping a company decides to improve its balance sheet or return cash anymore, is it?
No, not at all.
With those tax benefits and government incentives actively targeting those historically low PBR sectors, this feels like it's becoming a long-term structural trend rather than just, a temporary market theme.
That's the fundamental shift. It's the government actively using the tax code and other incentives to try and correct what people have long called the Korea discount, that tendency for Korean stocks to trade cheaper than global peers.
Right.
So for you as an investor, Track B offers potential stability and mandated return improvement, acting as maybe an anchor, while Track A continues to chase that technological growth.
Okay, now let's try and connect this back. We have this demand for quality, the massive financing needed for AI. How does this all ripple into the fixed income world? The bond market saw some pretty extreme volatility after that November 7th jobs report. It looks like a huge battle between recession fears and just the sheer amount of debt out there.
That October U.S. non-farm payroll report was definitely the trigger. It came in dramatically weak. I think it was only, 90,000 jobs added, way below the 150,000 estimate.
Yeah, much weaker than expected.
And the unemployment rate unexpectedly jumped too, up to 4.4%. That sent a clear signal.
Yeah.
The labor market, which is the Fed's primary focus, right, it seemed to be cooling much faster than anyone predicted.
And the market reaction was pretty explosive, wasn't it?
Oh, absolutely. Rate cut expectations just immediately skyrocketed. The short-term 2-year Treasury yield, which is super sensitive to what people think the Fed will do next, it dropped by over 20 basis points, in a single day.
Wow.
Money markets almost instantly priced in a near certain chance, something like 90% of the Fed actually cutting rates in December. The market basically screamed, recession coming! and bet heavily on an immediate policy U-turn from the Fed.
Here's the puzzle, right? Despite all that fervent betting on rate cuts, the long-term 10-year Treasury yield,
Yeah.
it barely budged in proportion. If recession fear is suddenly so high, why are long-term borrowing costs refusing to fall significantly? What force out there is bigger than recession fear right now?
The force is this relentless structural supply shock. It's like a tidal wave of debt coming from two enormous sources. First, you've got the government.
Still borrowing heavily.
Record global debt issuance continues. After that temporary government funding resolution in the U.S., the Treasury is just constantly issuing massive amounts of debt to cover ongoing spending and deficits. They're flooding the market with supply.
Okay, that's one source. And the second one links right back to our first discussion point, AI.
That's right. Big tech's AI expansion requires absolutely massive financing. The cost of building those data centers and buying all those specialized chips we talked about, it's not all covered by cash flow alone.
They need to borrow.
Exactly. Just this past week, Amazon, for AWS and Meta, they issued a combined, $30 billion in corporate bonds specifically to fund their data center expansions.
30 billion, just like that.
Yeah. They are effectively soaking up market liquidity and competing directly with the government for investors' capital. That continuous huge supply of debt, both government and corporate, keeps those long-term yields elevated, almost regardless of weaker economic data like that jobs report.
So the two key bond indicators, the 2-year and the 10-year yields, so they're telling us two completely different stories. One about the immediate economic direction and Fed policy, the other about this underlying weight of debt.
That's a perfect way to put it. The 2-year yield acts like the Fed's compass, right? It points towards where policy is likely headed based on incoming economic data. But the 10-year yield, that's more like the market's chain. It reflects the structural burden of supply and demand for capital, heavily influenced by government borrowing needs, and massive corporate investments like AI infrastructure. You really have to watch both to understand the full picture, all the stress points in the system.
Okay, so for you, the investor, facing this really extreme dual uncertainty, you've got recession fear pulling yields down, but this massive debt supply pushing them up.
Yeah.
What's the actionable strategy for fixed income? How do you navigate this?
Given that conflict, we strongly recommend considering the barbell strategy for your bond allocation. It's about positioning yourself for, both potential outcomes or extremes.
How does that work?
You keep one side of your portfolio highly defensive. Use high yield but very low risk instruments like treasury bills, T-bills, or money market funds. Park your cash safely there. Earn those high short-term returns that are currently available. That's your safety net.
Okay, defense on one side.
And the other side of the barbell should be focused on opportunity. This means holding some long-term bonds. Why? Because if a serious recession does hit and the Fed is forced to make those aggressive rate cuts the market is flirting with, long-term bonds could generate huge capital gains as their prices rise when yields fall sharply. So essentially, it's about hedging the known risk, the current volatility, and high short-term rates, while preparing for the potential tail risk of a significant downturn.
Got it. Hedge and prepare. Okay, so to summarize this really critical deep dive,
Yeah.
we're clearly in a major market transition. The whole party that was centered purely on AI growth seems to be winding down.
Yeah, the focus is shifting.
Now it's all about verifiable profitability in the tech space and following the structural policy shifts, particularly in Asia. It sounds like investors absolutely must prioritize financial quality and maintain portfolio balance using strategies like that two-track approach in stocks or the barbell approach in bonds.
Exactly. And maybe here's one final provocative thought for you to consider as we wrap up. This massive wave of bond issuance by tech giants, the Amazons, the Metas, to fund their AI build-out.
Okay.
It's not just a financial markets footnote.
Okay.
It is structurally raising the cost of borrowing for almost everyone else. This intense competition for capital, fueled by what you could call AI debt, is likely to deepen the economic divide. We're already seeing that K-shaped recovery dynamic.
The split between the haves and have-nots.
Precisely. You'll have the cash-rich, highly creditworthy market leaders who can borrow relatively easily, even if rates are higher. And then everyone else, smaller firms, maybe even consumers, who will find it much harder and more expensive to access capital. In this environment, financial health and strong creditworthiness, they become the ultimate defense.
A really important point to end on. Financial health as the key defense. Don't forget to subscribe and hit that like button.